Bangko Sentral ng Pilipinas raised interest rates by another quarter of a point to arrest rising consumer prices. Inflation soared to 5.4% last month, the fastest in over 3 years. Will this fresh rate hike reduce economic risks? Let's get some insights from Nomura Chief ASEAN Economist, Euben Paracuells, joining us now from Singapore. Euben, thank you so much for joining us. Good evening. So with this quarter-point move by the Bangko Sentral, will this tame rising prices in the Philippines?
Hey, Rico, good to see you. Yeah, I think it's still too early to say that because this is only the beginning of the normalization. It's only been 225 basis points hike. The policy rate is still at 2.5, which I think is still relatively low. So I think too early to say. I think also it's not just monetary policy. There has to be a combination of what they call non-monetary measures. We're still waiting from the new government on any of those things.
What should be these non-monetary measures, Euben, to be able to tame inflation?
Yeah, I think there's scope for productivity and logistics improvements that can be done, although I think the results will not be immediate. I think fiscal policy can help a little bit, maybe some targeted subsidies to certain sectors to mitigate the impact of higher prices, and maybe even reduction in prices of input costs by reducing tariffs or excise taxes on a temporary basis. I think that these will help, and this is something that we're seeing being implemented across many countries in the region.
And this will be, of course, the work by the new economic team of the President-elect Bongbong Marcos, which is led by the former Central Bank Governor Ben Jokno, who is now the incoming Finance Secretary. But despite the hike, Euben, the peso continues to be bombarded. It's slumping against the US dollar. It is at levels not seen as in 17 years, in 2005. Will it continue to be attacked because the Bangko Sentral was not as aggressive as others thought it would be?
Yes, some participants are, in the markets are making that argument that it is because of the BSP not aggressive enough. But I think that's only one small part of the story. I think the more fundamental driver of the currency weakness is really the fact that the Philippines is running a current account deficit. In other words, there's always a natural demand for dollars domestically when you have that deficit. And the deficit is actually increasing, and it's only going to increase given oil prices, given the vulnerability to imported food prices as well. Yeah. So if that doesn't get addressed on a more fundamental basis, I think the pressure in the currency will continue, whether or not the BSP goes aggressive when it comes to policy rate hikes.
Yeah, because the next meeting is still in another month, and they may not move from now until then. So if we see sustained pressure on the Philippine peso, how far will it fall? Could we see it at 55 or even 56.50, which could be its historical lows since 2004?
Yeah, I think we've been pretty cautious on the currency for a while now. Our team has been saying that 54 and a half will be breached, and it has happened. So the question is, how low can it go still? I think, we're still in the process of really reviewing our forecast, but at this stage, I think the direction is quite clear. Again, on a combination of things.
So in between meetings, Euben, could we see the Bangko Sentral intervening, maybe using its foreign exchange reserves, or will it use another interest rate hike to stem the falling peso if we see it at 55 or 56?
Yeah, it's got to be a combination of both. I think the FX reserves, using that is always the first line of defense. And we know for a fact that BSP has plenty of that. They have sufficient buffers. But of course, if the pressures persist and then inflation keeps going higher, I think that would necessitate the BSP also raising rates in tandem with these interventions. So I think it has to be done together to kind of reduce the pace of depreciation of the currency.
And if you're also thinking, if you're also in the position of the Bangko Sentral, they're currently walking on eggshells. You have a mild policy tightening, further weakening the peso, and then this, of course, translates to a higher Philippine oil import bill, which will spike since the country's imports all fuel needs, putting further pressure on pump prices. Prices will rise across the board and consumers will suffer. And because we're a consumption-based economy, it may not be looking good. Maybe lower growth rates in the second half of the year.
Yeah, I think this is really the main implication in all of this. I think policymakers in the Philippines have a really difficult task ahead in containing inflation, but also at the same time, you've got external pressures because you are running a current account deficit and you have the Fed raising rates more aggressively. I think ultimately what this means is that the economy has to slow. This is really what's going to drive inflation lower. Demand has to come down. And policies have to be kind of coordinated to try and engineer a soft landing rather than a hard landing. I think that's what we would be kind of most hopeful for if we are not going to go into a recession.
So what is Nomura's forecast for the remainder of the year? By how much could we see a reduction in economic growth? And of course, the U.S. is already forecasting a potential recession. Could that happen to the Philippines?
Yeah, so our house view on the U.S. is they're going to go into a recession and it starts in the fourth quarter of this year. So when it comes to GDP growth in the Philippines for this year, I think it's still relatively okay. They could achieve still maybe 6.7, 6.8, maybe close to 7% even. But the bigger question is next year, where we already have a slowdown anyway before the U.S. recession. So we're talking about 5 to 5.5% growth. But if you factor in U.S. recession, I think that could bring it much lower. So probably closer to the 3 to 4% range next year.
But the good thing about the peso depreciation, Euben, means more overseas Filipinos remitting their foreign currency, which could also boost domestic demand.
Yeah, that's right. I think that's one side effect, but it's only a small one, if you ask me. I think the bigger issue really here is what it does to inflation as well. Right. So I know the BSP kind of downplays a little bit the sensitivity of the currency and the pass-through of that on domestic inflation. I think it's a lot higher in this environment. Like I said, oil prices are going higher. Global food prices are going higher. And if you look at the Philippines, the vulnerability on both fronts are actually relatively high compared to the other countries, just because we're a larger importer of these products. And so I think that the currency could play a role in actually exacerbating inflation and inflation expectations domestically if it continues to depreciate.
Many challenges ahead for the economic team of the President-elect Bongbong Marcos. Euben Paracuells, Chief ASEAN Economist of Nomura, joining us from Singapore. Thank you so much for your insights.